Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus is coming at you right now. And a little different spin today on the podcast where, the multifamily asset class is part of, obviously, the overall commercial asset class, commercial real estate asset class, which includes everything from industrial to retail to hotels, hospitality and offices, and of course, self-storage and mobile homes. And I would say that the self-storage space in particular is really a kind of a close cousin to multifamily. It's almost like you're renting apartments without the tenants and toilets attached to them. And, for a lot of people, they've kind of cracked the code on how to be wildly successful in the space and have a lot less of the property management and asset management headaches that can come along with multifamily. So we've got a guru on the show today. Scott Krone is his name, and really excited to talk to him about his foray into his architecture work and design and build work, and also he started in multifamily, so he knows multifamily well, and is now 100% in the self-storage space. So, Scott, super stoked to have you on the show. Welcome.
Thanks, Tate, for having me. I'm really looking forward to this. I appreciate it.
Before we get started, dude, you've got a red hat on with an L on it. Can you tell me about that?
It's the University of Louisville. I want to give a shout out to one of our neighbors where we just closed our construction loan. We're going to be developing 144,000 square feet in downtown Louisville, and We're halfway between the university and the Bats. But with football season coming up and women's soccer, we want to give a shout out to those teams and support our local neighbors.
Awesome. That's a self-storage facility in downtown Louisville?
Yeah, it's 144,000 square feet, and we'll have around 80,000 gross of self-storage and 60,000 gross of flex warehouse space.
Okay. Is that a vertical building, like, multiple stories kind of thing?
4 stories and a basement.
Okay. Awesome. And normally don't get into current deals right away like this, but is this a deal that you were hired to do the design build type stuff on, or is this is your deal, I'm assuming, right?
Well, the answer to your question is yes. So
okay, both. Yeah,
it is our deal, and we did hire our other company to do the work. Yeah.
Okay. Internal hiring. I like that. It's vertical, right? Keeping stuff in house. So, well, cool, Scott. So, if you would just share a little more about your background. You've got quite a history in your architecture space and in the real estate space. You own 5,500 self-storage units. That's awesome. That's tremendous. So if you would just kind of, like I said, share with the listeners, share with me a little bit of color on your story, your trajectory, and kind of how you got to where you are today.
I appreciate it.
Yep.
When I was doing my architectural graduate work, so I was getting a master's in architecture at Illinois Institute of Technology, I got connected with a developer who was a professor, who was also an architect and a contractor. And he had us working on real life projects. And so my master's thesis was a 400 unit multifamily development.
Wow.
And so during my TA period, I was working on all the development, all of the financial performance and modeling. And then in class and in my homework, I was doing all of the design side of things. And so I was literally working on this, around the clock for 3 years while in school. And then when I graduated, I continued working with him. And I was also in charge of developing other projects that we were doing there. So it was like a 40-unit multifamily development and a 57-unit multi-unit development, yep. Mixed use, and then also converting apartments and things along those lines.
Yeah, got it. Cool. So, that was in the multifamily space, right out of your educational space. Tell us how that evolved into self-storage.
Well, when I started my own company in 98, so after working there for 6 years, I thought I knew everything. The ripe old age of 28, bold and aggressive.
Yeah, you're almost 30 then. I mean, that's like you've arrived at 30, right?
Exactly. I'm like, it's all downhill after 30, right?
Yeah, totally.
And so we first did single family. We did a couple single family homes, and then we started getting into multifamily again and mixed use. And we were doing that plus also developing some churches. And then the market crashed, right? We had the big crash in 08, 09, and everybody was pushed into multifamily because that's all that lenders were doing. And so I saw massive cap compression, and it was just, the space was too aggressive. And I had a customer, I was teaching college architecture, but then, I moved over to coaching real estate, and I had a client who wanted me to find him a distressed self-storage, and I couldn't find it. And I was like, we're in the height of this depression, this recession, if you will. Why is it that we cannot find anything that's really, truly distressed? And that's when I began studying the marketplace. And I went back and compared the gross domestic product of the GDI of our country compared to when we were in recessions, and then comparing the occupancy level of self-storage. And what I noticed is that every recession, there was a slight downtick, and then it would accelerate up. And during that entire period of time from 1979, which was the first when we had stagflation and all that, which is very similar to what we're experiencing now. Every self-storage was always above 90% occupancy. I'm like, what other asset class, is above 90%, occupancy during this entire period of time? It was incredible. So that's why we sold off our multifamily and we began just developing solely self-storage.
So you saw an opportunity in the market based on the amount of demand that asset class was creating, or was the amount of demand it was under. And in spite of the recession and the downturn, and that really kind of speaks to what I know about this, which is, there's this metric called the SHARPE scale, SHARPE, I believe is how it's spelled. And it basically, the SHARPE scale just measures the volatility of different asset classes. And specifically in real estate, commercial real estate, you've got a very wide range, right? Like, so, in a downturn, the hotel asset class takes a big hit. It's very volatile. Retail, same way, office, kind of same way. And so those are at the very top of the SHARPE scale. And down at the very, very bottom is, I believe it's multifamily is number 3 in terms of being the least volatile. And then you get into self-storage and storage units that are even less volatile than multifamily. And if you think about it, on the one hand, it makes sense, but on the other hand, you've got a universal need for housing that everybody needs to have. Not everybody needs self-storage, but people keep their stuff. Like, that's the bottom line, is like, and this better than me, Scott, is people want, they want their stuff, they keep their stuff, they're willing to pay for it. And a lot of times it's such a low expense monthly relative to replacement and everything else that, it goes on a credit card. It's an auto pay. It's kind of forgotten about. And, why would anybody cancel the auto pay? There's all of that. So, this is, like I said, it's a close cousin to multifamily. And for listeners out there that, want to be in commercial real estate and maybe aren't resonating with multifamily for whatever reason, and you're listening to this show, so you probably are resonating with multifamily, but this is a little different lane that you can consider going down. And I would recommend, if you're going to do that, to really pick that lane and do it, and not necessarily keep one foot out the door in multifamily. If you're doing that, Scott did, he sold all of his multifamily, went 100% into self-storage. So what's the, are we in the kind of a similar space as far as the amount of demand on self-storage right now?
Well, first of all, I loved your introduction because I agree with you, everything you said, in terms of, people will say to me, like, I get multifamily, but I don't get self-storage.
Yeah.
And, and I often use the description, it's apartments without toilets.
Yeah.
It's like a more simplified box, right?
Yeah.
And hotels fit that too. We're renting, by a month, a hotel's renting by a day.
Yep.
Hopefully by a day, not by the hour. And then, you can
right.
And then you get into apartments, which is also by the month, but they're just more complex problem. They're more complex solutions to the same problem, right? Yep. We need space. So to answer your question, the difference is that, one of the challenges I had within multifamily was being able to really identify what the market was, how much market could, hold the demand, where was the supply and the demand.
Yeah.
And within self-storage, we can identify that very specifically. So there's some markets that are way oversaturated and we won't go into. And then there's other markets which have tremendous amount of demand, which we can come in and fill. And so we can analyze that marketplace and know where is a good place to go in for an investment versus a not so good place.
Yeah.
And it can be within the same city for sure, because the market is a 3-mile radius or 5-mile radius.
Yeah.
If it's rural, it's how far are you willing to drive in 20 minutes? In New York City, that's like 2 blocks, but out in the country, that's like 20 miles, right? So it's all a matter of, that specific marketplace.
Yeah.
So that's what we really study, is that 3 to 5 mile radius.
Yeah. And they say that all politics is local, and, real estate, location. Like, you can be on one side of a river or a highway and be in a completely different market than the other side, as far as, value and demand and vacancy rates and all that stuff. So it really speaks to the necessity to be an expert in your market and your sub-market, so that you're making good choices as far as the asset class goes, and as far as the your purchases go. And so, again, it's the same as multifamily in this regard. Like, you got to know that market really well, and you got to not only know it well, but you need to be well resourced and well networked in that market, in my opinion. To be really successful, to be wildly successful. That's what you need. Did you guys pick a certain market and go after it, or how did you go about that?
Well, the first market was in Chicago. So that's where we're from. That's where we are.
Yep.
And so we did 3 in Chicago locally. And then, we went to Milwaukee next because it was within an hour. And then when we were doing Milwaukee, someone said, hey, this would be a great thing for Toledo because Toledo's expanding. And so we found a building that met that criteria in Toledo. And then the broker's like, hey, I found a building in Dayton, which was, again, this is within a driving radius for us.
Yep.
So then we identified Dayton, and then we found a building in Louisville. And then, we found those are all development ones. Those we converted underperforming commercial buildings into self-storage.
Okay.
And what was interesting, the third one we did in Chicago was the original Lincoln Log Factory.
Oh,
and
wow.
So there's, some history there.
Yeah.
The one in Wisconsin was the first fireproof building in Milwaukee. And so we got historical tax credits there. And so within each of these, we were able to implement different tax structures as well in terms of what we were able to do. Mm-hmm. The one in Jackson, Michigan was the first existing facility that we bought where we're just improving the performance of it. Mm-hmm. We're not doing any development. We're just improving the management of it. Mm-hmm. But all the other ones that we're doing are developments. We're even doing some ground up developments now. But one key distinction is that when we did, 400 units in multifamily, that was $100 million. And when I was in the apartment arena, we were looking at like how much you're paying per door, right? If it's 25,000 or 50,000 or 100,000 per door, but in self-storage, it's a fraction of that. We're like 9,000, 10,000. And so I can have a more diverse portfolio at a fraction of the cost.
Yeah.
And we have a lot more flexibility in changing our product. In multifamily, I didn't have that flexibility, but if we need to take two 10 by 10s and make it a 10 by 20, we can take out the wall and,
piece of cake.
Boom,
Yeah.
it's a piece of cake.
Yeah.
So those are some of the distinctions that we see, is that if we're comparing multifamily to self-storage, is that it's just, our exposure is all tremendously less compared to multifamily.
Yeah, you're right. Cause you're, like you said, you're diversified. You have if you have a 50 unit apartment and you lose 10% of the residents, and you take on that vacancy, that's a big chunk versus, 500 units in storage. You lose the same number of units. It's less, it's way less income and everything else that you're losing. So it's just more risk mitigated. Okay, cool. That's awesome. And your background is part of what you do is the architecture and design. Are you doing this exclusively for self-storage at this point? You're with your architecture firm?
No. So we just finished building an extensive single family home in the market, in our local market. We've done churches again. So the clients that we pick on, that we're taking on for the design and build services or the construction services that are not in self-storage, or because we have a connection and there's a local thing. Like we're trying to do a project with Project Hood in the city of Chicago. It's a tremendous story. It's this pastor moved into the worst neighborhood in the country. It was literally deemed the worst block in the country. It was on the south side of Chicago, and he started a church. And across the street from the church was a motel that was a massive prostitution and drug haven. And he went to the owner of the motel and he said, "You need to clean this up. We're trying to change the community." And the owner said, "What are you going to do about it? You're the third church on the block. Nothing's going to change."
Right.
So he got a ladder. He went up on the roof, and for 90 days he was up on the roof until he raised enough money to buy the motel. He bought the motel and tore it down.
Wow.
So 10 years later, he's been on the roof all winter and now into the summer, and he's trying to raise $30 million to build a community center. And so I had the opportunity going down there with some other people and hearing his story and, just learning about what they were doing. And we're up on the roof of these shipping containers, and he's got tents up there. He's got his fire and all this. And we're up there talking. And, I said to him, there's two ways to build this. You either raise 30 million or you make sure it doesn't cost 30 million. So have you signed up a GC? Have you looked at what's going on with this? And he said, "Well, we have some proposals, but they're high right now." Mm-hmm. And I said, "Well, I'll take a look at it." And, we came in our proposal 27 million. And, I was like, there, and you save 10% right there just by making sure you're building it cost effectively. Mm-hmm. So, we'll do special projects like that because of, what they mean to us and how, we have connections and stuff like that.
Yeah. Okay, cool. So is any of your business, I'm sure you're doing architecture design for your own storage units, but do you have kind of a niche in that space as well, as far as, doing third party stuff?
We do third party. So we're working on 2 projects in Florida, and we're also working on a project in North Carolina and Virginia, where we've been hired to do these things. I would say that we're the only ones that do development, design, and build. And then we also have our own management company called One Stop Self Storage. Mm. So I think that we're probably the only one that does it from beginning all the way to end.
Interesting. That's way cool. And so you do third party management as well with your management company? No,
we don't. We only manage our own. So
Got it.
We're not going out into the marketplace and trying to market ours to other owners.
Got it. Okay. So, for somebody that has been working in the multifamily space, either doing deals or wanting to do deals and kind of working towards doing deals, and hasn't considered self-storage before, can you kind of make a case for why they should, or maybe hopefully you think they should, but yeah, just kind of, like I'm pretty good at going through the advantages of multifamily and why it's such an exciting space and whatnot. Are they pretty much the same? Like, I guess they kind of would be. Like, you've got your income, you've got appreciation, you've got the ability to force appreciation, you've got tax advantages, you're paying down debt, all that stuff. Are there any what's unique to self-storage in that realm?
Well, a couple different things. One, everything you identified is true. But when we're doing development, 50% of our investors are coming to us for tax strategies. So in Wisconsin, we got historic tax credits. In Toledo, Dayton, and Louisville, we did opportunity zones. And so people are able to shelter significant amount of capital gains as well as tax advantages. Plus we do cost segregation, all those sorts of things. So you can do that in apartments. It's just harder. If you're buying a building with an opportunity zone, you have to improve it 50%. That was the designation of significant improvements. So if you're buying an apartment building for, $10 million, are you going to be able to put $5 million into fixing it up?
Yeah.
Maybe not, right? But when we're buying underperforming commercial buildings that we're buying for $11, $12, $13 a square foot, we can easily accomplish that. So the biggest thing that I would say is why someone should get into self-storage is the main difference between multifamily and self-storage. It's also a retail business. And so we understand the market. We understand who we're marketing to, who we're advertising to, all those things well in advance. So our marketing is a lot more specific than what we were doing with apartment buildings. We're able to, do a lot more on the social media in terms of getting paid for clicks and all those sorts of things. But knowing that it's a retail business, and we don't have the eviction laws that multifamily has. I will not buy an apartment building in the city of Chicago. It is so onerous towards an owner in Chicago. Right. I don't know how people survived during the pandemic because without all the tenant mitigation in terms of rents and all those sorts of things that were still going on. Like the teachers union was striking in Chicago about going back in and teaching during COVID until they enforced that they would have more mandates in terms of tenant protection for rent protection. And I was just like, what does that have to do with teachers? The teachers aren't teaching because, this is just, that doesn't make sense. Yeah. But it makes it really hard to be a landowner in the city of Chicago because the tenant laws are so onerous. We don't have that, so when we converted it over to our facility, the previous management company, which was a major REIT, that was just not performing. They didn't even have contact information for a lot of the tenants. And our process was we just came and cut locks, videotaped it, couldn't reach them. We cut locks and had auctions and we're done with it. We're moving on. We're not having to go through the courts and all that to evict people.
Yeah. Okay. So there you go. It's an easy process when somebody defaults on their lease and way more easier than multifamily, no matter where you are in the country, because the laws for multifamily don't necessarily apply at all to self-storage. So
right.
That makes a lot of sense. You've got way more markets to work within because you can shop in the less landlord friendly markets because they don't really, it doesn't apply to you. So I get that. That's exciting. What about financing and equity and that sort of thing? What are the differences there between multifamily and self-storage?
When I first got into it, I would say that there was less lenders who were open-minded to self-storage. Okay. Let's just multifamily was the golden goose of bank debt financing because of the fact that, when the crash came, every lender basically drove right to multifamily, which is why we saw this massive cap compression going on. And the reason why I got out, because I thought we're at the height. So this is the best time to sell. And I missed that, I was 5 years too early in terms of that, maybe caps are raising right now, but, I figured hey, this is a great time to sell. But now we're seeing more and more, traditional lenders being willing to get into it, especially on the development side. And there's really three asset classes in terms of a distinction between multifamily and self-storage. When we say Class C multifamily, it means not so good of a neighborhood, right?
Yeah.
In Class C and self-storage means, well, it's a smaller traditional drive up mom and pop owned, maybe 100 units. A Class B doesn't mean it's like in a better neighborhood. It just means it's more suburban, it's bigger, and it might have climate controlled. And then a Class A doesn't mean it's in the best neighborhood. It just means that it's like over 500 units and fully climate controlled and drive in and all that. It's like brand new facility. Yeah. And so to answer your question, if you're an investor trying to determine which one, the first thing we always say to people is, what are your goals? What are your objectives?
Yeah.
If you want to be an owner operator, Class C is a great place to begin. If you want to be a passive investor, then a Class A is a great facility for you.
Yeah. Yeah. Got it. Okay. Makes total sense. That's awesome. Okay. So what else should we know about storage units in terms of, distinctions between it and multifamily, and then, as importantly, just kind of overall qualities of the space?
Well, people always ask us, like, what is the biggest driver in the facilities that we're doing? And it's dry, safe, and secure. That's what you're trying to accomplish, right?
Yeah.
It doesn't have to look like the Taj Mahal. The only reason why they're starting to look like the Taj Mahals is because the local municipalities are demanding it.
Yeah. Yeah.
As long as it's dry, safe, and secure, people want it.
Yeah.
And so that's everything we do. And then, so in these, buildings that we're converting, we put up 8-foot high corrugated metal walls, and then there's chicken wire across the top. And the reason why is because that way, when we do lighting, we don't have to light up every single unit. We don't have to put HVAC in every single unit. We don't have to put sprinkler heads in every single unit. We get the benefit of that because with the chicken wire, we get the light, we get the HVAC, we get the fire protection all through there. And so we can put in motion sensors, timers, all those sorts of things to make our buildings extremely efficient, which is what we did in Toledo and Dayton. We actually got PACE financing, which was an energy performance product through the Department of Energy, implemented locally. And because of that, there was a way in which we could get non-traditional debt financing onto our projects.
Yep. Yeah. PACE financing, for listeners, that's available to, to you and multifamily if you're in that space. And it's basically, basically second position financing that is based on, let's say, eco-friendly or environmentally friendly improvements that you're making. They can all be financed through the PACE financing. Do I have that right?
The only thing is, it's not really. Some banks consider it a second position, but it doesn't count. It's above the line item because it gets applied as a special assessment to your property taxes. So it shows on your income statement as your special assessment on your taxes, and so you don't have a second mortgage. It gets paid through your taxes. Yeah.
Okay. Got it. Very, very cool. Something to look into for listeners if you're doing CapEx projects and you can put a environmental spin on it. That very well may qualify for PACE financing. So
the only requirement is you have to improve the economic performance of the building. So think about it. If you're putting on a new roof and you make it reflective, if you put in new windows, you put in insulation, you change out your boiler, all these things are going to have a higher energy performance than the previous product. And so that's the requirement. That's the only condition.
Yeah. Yeah. Got it. Right on. Well, this has been enlightening and compelling, to hear your story and to hear your thoughts on this asset class. If people want to reach out to you and, network with you, learn more from you, what's the best way for people to reach you?
Well, Tate, I appreciate that. And what we'd like to do is offer your listeners two things. One, when we do a job, we hire a feasibility consultant to do a study on the location, and it explains why we should or should not go after a building or a product or that market. And so the one we did in Dayton for our Dayton, Ohio facility, we will give that to anyone who references this shows and emails us. The other thing we'll do is we'll give them a self-storage analyzer. And so, like, for instance, you don't have to realize that multifamily is like 55%, typically 50 to 55% expenses. Self-storage should be like 25 to 35. And so you can plug all that in and determine if it's a good deal or not. So you can compare, a self-storage facility to a multifamily and determine which one's the best one. But we will give the analyzer and the feasibility study to anybody who reaches out to us. And the best way to do that is at info@Coda, CODA, MG for management group.com. That's info@CodaMG.com.
Yeah, great stuff. And like here again, listeners, like you tune into this podcast for value and resources and actionable steps and inspiration and all that. And you just listen to Scott really break this space down, and he's offering you a free resource just for reaching out to him. So take him up on that. It's just one more step here that you got to make, to send an email and go get what Scott has to offer. And, all this stuff is super valuable. If you get one big thing or two things or three things out of the resource, then that's a win. So, again, like when guests on this show offer something to listeners, it's really generally a very high value, and is gonna really likely get you some good stuff to help move your business forward. So that's very generous, Scott. Really appreciate you offering that. So can you think of anything else that we didn't hit on? Any kind of final thoughts on the self-storage space?
Well, I think, we covered a great deal, and obviously your introduction covered, was a great layup, if you will, for our product. So we really appreciate that.
Yeah.
I think the other thing is, you don't have to buy this big portfolio. You can start small.
Yeah.
And, a mom and pop facility might go for $400,000 or $500,000. So you don't have to. I mean, the one we just bought was $2.5 million. And we're going to value improve it to probably close to $4 million just by changing the income on it. Mm-hmm. And so, there's significant gains that you can accomplish within, slight margins. So it's a great product, especially if you're beginning in real estate.
Yeah. Yeah. That's awesome.
The other thing is, if someone does have something that they want to discuss with us, again, the community within self-storage is so small. We're not going to try to steal any deal.
Yeah.
If you have questions, just email us, let us know what your question is, and we'll be happy to answer your questions for you.
Yeah. Awesome. Great stuff. Scott, this has been amazing. Thank you so much for spending time with me on the show and kind of opening your playbook up for the listeners and sharing your resources and your gift. Really appreciate all that. And listeners, hopefully you got a lot out of this, even if you're going to continue to stay in the multifamily space. Like, this is all just really good specialized knowledge, and it's good to know differences and nuances, and like the more you know, the more you grow, right? So yeah, again, Scott, thanks a ton. Listeners, thank you for listening to another episode of the Apartment Gurus podcast. We're doing 2 a week now, so we'll see you here in a few days, and looking forward to it. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.